The Committee on Financial Institutions will now come to order. Madam Secretary, please call the roll.
Chairman Francis.
Here.
Vice Chair O'Donnell. Here. Representatives Clemens. Here. Adams. Here. Billington. Here. Butts. Here. DeGroat. Here. McGurl. Here. Owen. Railsback. Sander. Sauls. Shaw. Thompson. Here. Trent. Thompson, I got okay.
A quorum being present, we are going to begin our committee hearing by hearing House Bill 2845, sponsored by Representative Riley. And so, Representative, if you'll come forward, and you may begin when ready.
Thank you, Mr. Chair, Mr. Vice Chair, and members of the committee. My name is Alex Riley. I'm the state representative from the 134th District, which covers portions of Springfield and Greene County. Thank you for changing your order up of business today and letting me present my bill first. I certainly appreciate that. One of these situations where I'm supposed to be in two places at the same time. So we'll dive right into it. House Bill 2845 in front of you today provides an estimated $84 million in federal tax relief for Missouri-based small businesses by putting them on a level playing field with major C corporations and, through state and local tax, which, as you all know, is referred to as SALT, and I'll refer to it as SALT throughout the presentation. Parity language that has passed in over 22 states over the last 3 years. This SALT Parity Act creates the option for pass-through businesses to pay their state income tax at the entity level rather than on the owners and partners' individual returns. This allows the owner to bypass the federal cap SALT deductions and prevents double taxation for businesses with income from multiple states. So that's the high-level overview. I'll dive into it just a little bit here. So specifically, SALT parity reform and the tax structure set forth in this bill before us today is needed as a result of the 2017 federal tax reform legislation, which capped these SALT deductions for individuals and pass-through entities at $10,000. The cap was not placed on income for C corporations. Just as a quick refresher, and I think looking at the committee, most everyone would be familiar with this, but pass-through entities include S corporations, LLCs, and partnerships. These include a mix of large and small businesses, but frequently are composed of professional services firms, clothing, home goods, food and beverage retailers, general merchandise retailers, construction entities, and physician offices, just to name a few. In reality, the majority of businesses in the United States are organized as pass-through entities, and they certainly compose the heart of all of our local economies and all of our districts. The issue is the federal SALT cap hurts these businesses and threatens our state economies and specifically a lot of these smaller businesses by favoring C corporations, which by and large tend to be larger corporations. Because it increased the federal tax rate for businesses organized as pass-through entities, drove up the tax burden on our local businesses, which in turn makes it harder for them to hire workers, for them to grow, and for them to contribute to all of our local economies. The tax structure set forth in this bill before you today in House Bill 2845 is designed to restore parity to this overall tax structure. So the next question you might wonder is, how does this actually work in practice? It sounds great on paper, but how does it work? So the federal SALT deduction cap applied to individuals making tax payments, but not to businesses making tax payments. In Missouri, pass-through income is taxed at the owner level and is subject currently under the law to that federal $10,000 cap. This House bill restores the federal SALT deduction for pass-through businesses by shifting the payment of SALT from the pass-through entity owners to the businesses themselves, thereby making those payments deductible at the federal level. So the business pays the tax, then deducts the payment, as a business expense. This results in income flowing to the owners to be reduced on their federal taxes, while taxes paid to the state of Missouri would remain the same. It's important to note that the new tax structure set forth in this bill is optional. If a entity likes the current tax structure, they can stay and pay the taxes under that current tax structure. So it's completely optional. It would only be if an entity believes that this provides a more advantageous tax system to them that they would take advantage of this. There's nothing in this bill that changes that. Another really neat thing about this is that it's completely revenue neutral to the state. And we have a fiscal note that you all may have in front of you that confirms that. It will have a 0 next to it. So while Missouri's taxpayers could receive up to $84 million in tax relief, this new tax structure is revenue neutral. It's the best of both worlds, with our taxpayers being able to keep more of their hard-earned money in their own pockets and in our state with no hit to the state's treasury. And I would argue that while this isn't reflected on the fiscal note, there's certainly a likelihood that it would ultimately have a benefit to the state's treasury, because you have $84 million that's now staying in our state economy versus being transferred to Washington, so that $84 million will instead be spent within the state, which will certainly be subject to other taxes, which the state could then collect from. A couple final notes. The federal government has approved this tax workaround, if you want to call it that. So a number of states, shortly after that 2017 law went into effect, started looking at how can they mitigate the damage, frankly, to their state treasuries. And in consultation with the federal government, this was something that was ultimately approved. And now we're in a situation where you have 22 states across the country that have approved this tax structure. And this isn't a blue state, red state sort of thing. Number of examples: you have California, Oregon, Idaho, Arizona, Oklahoma, Arkansas, Illinois, New York, Alabama, Georgia, Massachusetts, Connecticut, Louisiana, Minnesota, Wisconsin, Michigan, North Carolina, South Carolina, just to name a few that have passed this. So a wide variety of political makeups there, certainly. Several more states are currently considering this type of legislation in their legislative sessions, including our neighboring state of Kansas, Ohio, Pennsylvania, and Virginia. All these states have come to the realization that these reforms help keep more of their tax dollars in their own states, boost the economies of their states, ensures that their state remains competitive with other states that are adopting these reforms too, and we should do the same here in Missouri. So with that, I've brought a number of experts with me to help answer any of the more technical questions, but I'm certainly happy to answer questions as well.
Thank you, Representative. Questions for the bill sponsor, Representative McGurl?
Inquiry.
Proceed.
Mr. Chairman. Well, it's not really a representative question, but kind of to expand that a little bit, because it's a good piece of legislation and it needs to be done. But to kind of inform people, when you talk about the SALT deduction, they're talking about state and local taxes, so that you understand that's where that $10,000 limit came from, the 2017 tax bill. And then, but one of the things, because I personally kind of encounter some of this now, because particularly with limited partnerships, you might get a partnership, but it'll have 8 or 10 state K1s, and what this allows to do is to get credit for those taxes that you are paid to the other state. Because if you elect at the partnership level because at the entity level to pay the tax at the entity level, and then that gets passed on down to the individual owners, partners, or shareholders as S corp, but I'm mainly talking about partnerships. It gets passed down to those folks, and then you, when you file your taxes, and if say you got a Georgia K1 or a Illinois or Kansas or whoever, this just allows you to be able to take the credit for those taxes that were paid. Otherwise, you lose them. So I think, this is something that needs to be done. It needs to bring our Missouri tax code up to what the standard is for other areas around the country. It's just a benefit for the, for the individual. Doesn't cost the state anything because they're still getting the tax revenue, but it helps the individual. So I really didn't have a question for you. I just wanted to kind of expand on what you had described there.
Thank you, Representative. That was helpful. I appreciate that.
All right. Thank you, Mr. Chairman.
Other questions from the committee? Representative Butts. Proceed.
Thank you, Mr. Chairman. Thanks, and maybe I'll defer until we get your witnesses up here. But when the 2017 federal tax code came along and there were changes, one of the issues were to limit state and local deductions at the federal level, $10,000. However, other rates for high income earners were reduced. So I mean that was part of the trade-off there. So just to say, to go back then and say, well, we want to just bump up or somehow eliminate that $10,000 cap, that was a careful balance. And I think I tried to, just real quick, because I didn't have this at my fingertips, but just get hold of my CPA real quick, because in Missouri, we're a relatively low tax state. So it affects less Missourians than it does New Yorkers or Californians, where they have very high state and local taxes. So there's a pretty high income level to where you will not get over the $10,000 range. I am in that range, so it affects me personally. I get all that. But on the C Corp, when you were making the thing, and maybe we'll get into this more with your experts, but I'm pretty sure this is the case. The reason why most small businesses, including ours, pick the LLC, which has become much more popular than Sub S, it's not just the flow through, but C Corps have a relatively high just base tax rate on all profits. And then, they've got to make their distributions post that. So I think it's a no-brainer, and why, and I don't know up to what number of employees, but I certainly know 100 employees or less, you will almost never find a C Corp. And it is just because this pass-through thing is such a huge benefit. So there's a balance here, and I'm curious. I get how it won't affect state revenues. I guess we'll get into the weeds on how on earth it doesn't affect federal revenues. But anyway, I'll wait for a comment there and defer to any of your witnesses.
Yeah, we can certainly take that up with the experts.
Further questions of our bill sponsor? Seeing none, thank you very much, Representative, for bringing the bill forward. Is there anyone here today that would like to testify in favor of House Bill 2845? Of course, you've carried your witness form. Thank you very much. Proceed when ready. Is that microphone on there, that green light on? The green light's on. May have to be a little bit closer.
Oh, there it is.
Okay.
All right. It was on in the shadows. It wasn't actually on. I apologize. Again, Chuck Pierce, I'm here tonight representing two organizations, the Missouri Society of Certified Public Accountants and Associated Industries of Missouri. And really, by representing those two organizations, I grab what the two issues are relative to this. One, there's a policy reason to address this, and the sponsor brought that forward, which is 22 states have done this, and so Missouri has not. So what that means is if I'm, as Representative Butts said, the vast majority of new businesses are started as pass-throughs. If I'm picking a state to do one, I'm going to pick a state that has this entity level tax. There is no reason not to, because for the most part I can do business wherever I need to do it, but having my nexus or my primary home in the state that provides that gives a big tax benefit to my partners. So when you look at the fact that we are rapidly being surrounded by states who have enacted this, the reason to have this in Fayetteville or Rogers, Arkansas versus Joplin, it makes a big difference because Arkansas has this pass-through. The other issue, and Representative McGurl hit on this, is an issue of complexity for Missouri and equity for Missouri taxpayers. So because 22 other states have done this, if you are a Missouri resident involved in an out-of-state partnership in a state that has one of these, two things happen. One, the complexity of your return goes up a great deal because you've got a tax in one state and not another. But two, the existing Missouri law does not allow a Missouri resident non-resident credit for the tax paid in another state. So let me rewind that. If you're working and you're a wage earner and you work some in Illinois and you work some in Missouri and you get a W-2 in both of those states, you file a return, the Missouri gives you a credit for the tax you paid Illinois against your Missouri return. If you are a partner in a partnership that has the exact same tax situation as a Missouri resident, you do not get that credit. So you are in essence double taxed because your partnership paid your Illinois tax on your behalf. It reduced what your partnership interest is worth to you. It gave you that as a distribution. But then you turn around on your Missouri return, you have to claim all that income and you have to pay it at the Missouri rate. So it's a double whammy. It encourages businesses to locate in other states, and it penalizes Missouri residents from expanding their business to other states. So we think this is a good bill. We certainly appreciate the sponsor bringing that. Be happy to answer any questions. It is complicated, but in essence what it does is the partnership pays the tax and gives a credit to the Missouri. Now, the partnership pays it at the highest Missouri rate, so the individual partners typically come in at a blended rate, so it's at least revenue neutral and, maybe even a tad bit positive for the state. And what it really does is it allows the state to restore a federal deduction that was eliminated by Congress. So there's no cost to the state, it just puts it back whole. And then to the issue of equity, C Corps do deduct that, and you're exactly right, Representative. There's the dividend tax on that. When they did the Tax Reform Act, they also increased the standard deduction. They basically doubled that. So for a lot of just average taxpayers, homeowners, really the standard deduction took up any interest that they would have had for their property tax or other issues on their mortgage. So, but what it didn't do is it didn't restore things to our small businesses and our pass-through entities, which are the vast majority of businesses that we have. Be happy to try to answer any questions.
All righty, thank you. Representative McGurl,
Inquiry.
proceed.
Chuck, could you kind of elaborate too, whenever the fact that you don't get to get this credit, you're still charged with it as far as on your partnership account, that reduces your capital by the amount of the tax that you don't get a benefit out of.
Correct.
So could you kind of maybe
Yeah, so what Representative McGurl is referring to is within a partnership, you have what's called a capital account, and that's really the consolidated net worth of that partnership, and a certain amount of that is allocated to each partner. Well, in the states that pay this tax, that equity is reduced. Well, that's fine because it would have paid your tax. But if you don't get that credit, your value in that out-of-state partnership just went down, and you didn't get any economic benefit for that. So, again, it's another example of how this penalizes Missouri residents in multi-state partnerships.
Thank you. Mr.
Other
Chairman.
questions for this witness? Seeing none, thank you very much for your testimony. Anyone else in favor of?
Thank you, Mr. Chairman, members of the committee. David Jackson, registered lobbyist for Allegis, Redwood, and Maxim Public Affairs. And our client built the coalition Main Street Employers Group, and they have helped lead this in the 22 different states that have passed this parity legislation. And our membership and steering committee members consist of the S Corporation of America, NFIB, as well as some other professional groups and associations that have state chapters that are here today, I believe, and a lot of businesses that are organized as pass-through entities. And so, the intent behind this was really to make sure that these pass-through entities are on par in competing with C corporations that are not subject to the same cap. So by context, whenever this initially passed in Congress, to Representative Butts's point, this was initially, a way to help pay for some of the tax cuts. But some of the high income tax states, your New York and California, and really New York was where it all started. They were worried about high income earners fleeing the state. And so they got creative, and one of the first workarounds they tried was New York created, kind of a nonprofit charity, shell that you could donate into and have an offsetting credit on your tax return, and try to bypass the credit. And the IRS said, you can't do that. And so our client, worked, and put together what is, now been blessed by the IRS and authorized in guidance as this optional entity level payment that if I think the easiest way to explain it is you write your state income tax check from your company checkbook instead of your personal checkbook. And when you fill out your personal, tax return, you are credited for the amount that you already paid through your company for your percentage ownership. And by doing so, you bypass that cap. It certainly would, reduce the revenue from Washington. To your point in question on that, you're still going to have impact by the cap in terms of other individual returns, across the country that, aren't necessarily your small business owners. And as Mr. Pierce mentioned, even your smaller businesses that, don't have your $10,000 in deductions will still benefit in the sense that they can, pay this at the entity level, but then still take their standard deduction on their individual return. And so it's an issue that, I would describe as a easy, complicated issue, and that it's not very often we get an $84 million tax cut for small businesses with no fiscal note to the state. But this is, why it started off in some blue states and in high income tax states. A lot of the red states followed because of the credit issue that Mr. Pierce mentioned, and just a competitive, matter of trying to attract businesses to the state and make sure that our small businesses can, compete fairly with C corporations. So happy to answer any questions and appreciate your time.
Representative Butts? Proceed.
Yeah, thanks. It was important to put that in there about, write your state income tax out of your business account. I think that helps clarify it. That makes a complicated issue simpler to understand. To your point, and I get how, we're the Missouri legislature, and it's, and I don't mean to be looking out for Washington in any way. It's not my position to be doing that. And I do know this started in New York primarily because high tax state, and it was exactly correct. There were people just going to move to Florida, live there 6 months in a day, and and save a bunch of money, and it really hurt New York. So let them figure out their own problems. But there's got to be some policy discussion, surely, and I guess like you said, it's approved by the IRS, so I guess we're making progress there. But it does have a fiscal note, shall I say, at the federal level, correct? It has to.
Yeah, look, you are. This will mean less Missouri businesses will be sending less tax dollars to Washington.
To Washington.
Absolutely.
Okay, yeah,
if you're
okay.
concerned about Washington, dollars, and you want Missouri businesses to send more money to Washington, by all means.
Yeah, no,
but
I agree
yes,
on that. I'm not going on the record for saying that. That's way.
And I'm not trying to pin you on the record.
No,
there,
that is way over my pay grade.
Yeah.
Way over. And I get how it would be. I'm surprised. Good to know the 22 states, and I really get it that if the border states of Missouri, this would be we'd be at a ridiculous competitive disadvantage because it's just too easy to pop over to another state. So I appreciate it. It was a good clarification. Thank you.
Yeah, and I'll clarify on that too. Some of the states, Michigan initially, the governor vetoed this the first year around because he was concerned that the feds were just going to change the policy, reject it, or take away the cap. And so that's the reason why this is an optional elective tax on the entity, because in the event that Congress does end up changing this cap, then it's just a dormant statute. You as a business just wouldn't elect to use it. And so in the IRS guidance has really given that security now that they are accepting this. It's not, kind of the charitable workaround that New York tried. This is a pretty sophisticated effort that was worked on in coordination with a lot of organizations in the IRS to make sure it was concrete and solid.
A quick follow-up to that, if I might. So, when you had made that point about, so people that don't get to the 10,000 SALT deduction, and, they're at 5,800, so they take that at the business level. And also part of the 2017, as was mentioned, we just greatly increased the standard deduction. So, I mean, that's even sweeter deal, right?
Right.
I mean, okay.
Yeah, absolutely.
Great, I appreciate the clarifications. Thank you.
Representative Sander,
Thank you. To inquire,
proceed.
can I hear your thoughts on the 90 days after the end of the tax year for the payment of the taxes? Because like currently, S corporations taxes are due like March 15th or business entities, and then you got April 15th for personal, and then this would be falling right in between it. And if there's a leap year, then you got another thing to deal with. Why the 90 days, or could we change it to be in line with March 15th or in line with April 15th, or?
That is a good question. I do not know the answer. I know this was, kind of model legislation that's been put together in all of the different states, and I don't know if that provision was adjusted pursuant to any, we've worked with the Missouri Department of Revenue before this was even introduced to make sure they were aware of everything and looking at it.
You've also got,
I will check on
like
that.
some business entities, their tax year could be September or
Right.
whatever day they've picked, and 90 days later, that's, and then if you file 941 forms, you got that March 31st or whatever day, you got a lot right in there, and I'm guaranteed I'll probably miss one of them.
Yeah, I will follow up. I do not know the answer. Maybe somebody does here. Chuck is certainly the tax guy that may already be whispering the answer here, so I
see it
don't
as
know.
one more date. I like the idea, but if we could line it up with something else and do it all at one time.
I can either answer that or I can.
Okay, offline's fine, or if everybody wants to hear it, go ahead, but
Mr. Pierce, go ahead.
thank you.
Just speak loud.
The 90 days has to do with the election, not necessarily the payment. Payment still would track with the filing of the return. That's really an administrative issue, but I've had the same comment. I think certainly we'd be agreeable to changing that. It just would have to kind of tweak the language to say, upon the due date of the return or something, so that revenue has enough time to know which business entities are making this election, because that also impacts all the personal returns of all the partners.
Any other questions for Mr. Jackson?
Mr. Chairman, one last comment I'll mention this for your awareness. This has been perfected as part of another piece of legislation in the Senate, too. So we've cleared that hurdle, hopefully, and it is hopefully moving this year. Thank you.
Very surprising, wasn't it? Any others to testify in favor of? Proceed when ready, sir.
Hey, thank you, Mr. Chairman, members of the committee. My name is Mark Rhodes. I'm here on behalf of the American Council of Engineering Companies, Missouri chapter. We are part of the coalition that Mr. Jackson spoke to. We've been working hand in glove. Our national association has been to help pass this in the 22 states. I am no expert. I'm happy to go on record in support. Be happy to answer any questions. Thank you.
Any questions for this witness? Seeing none.
Thank you, Mr. Chairman, members of the committee. Ross Lean with the Missouri Chamber of Commerce and Industry. I'd like to go on record in support of this bill, just echo what's already been said.
Questions for this witness? Seeing none, thank you, sir. Anyone else to testify in favor of? Okay, we'll switch gears. Anyone here to testify against? Seeing none, anyone here to testify for informational purposes only? Again, seeing none, then that will conclude our hearing on House Bill 2845. And at this time, the committee will now go into executive session. We have distributed a sub with amendments. And so at this time, I move the House Bill 2706 be voted do pass. Any discussion? Seeing none, I have a substitute. It has been distributed, and I move for its adoption. And I'd like for Mr. Penman to come forward and explain the narrowing of broker fee disclosure language.
Oh, yes, sir. Thank you. On page 6, if I want to make sure I got it right, I was looking at this. Page 6, parentheses F. Mr. Chairman? Okay, just.
Yep.
So we work with an organization that provides a factoring product. So some groups are legislation related. So essentially, they're companies that when an individual's been injured, they're going to receive health care. They may not have insurance to cover those costs up front, and there's a lawsuit that is being pursued. Our client provides financing to those healthcare providers to pay for the medical care during the term which the lawsuit is in, until the term the lawsuit is concluded. And then we're paid out of that. We're paid, not out of the judgment, sorry, then we are paid. So the language simply was to clarify that we have a fairly unique product, but not this product. Happy to answer any questions, and hopefully I created fewer than existed prior to me speaking.
So this was a change from our committee discussions last week, and I wanted Mr. Penman to step forward and kind of explain those changes. Are there any questions for him?
Yeah, I'm sorry, I didn't follow what the amendment did. As you know, you and your client talked to me a couple of years ago about this.
Yeah,
And,
yes, sir.
I think you wanted to fix my collateral source bill at the time.
I've been dying to help you with that bill.
Yeah.
Yeah.
I think your client would die because of that bill. If I'm correct and I understood her comments. And if you're trying to.
I shouldn't have engaged. I apologize.
Well, I just want to make sure because I think I was quite clear about how I said, if you're trying to sneak this in on some amendment while nobody's looking,
Representative,
I don't think you are, but I want to know.
No, I'm happy to clarify. Sure, if you look for section, is it 5? Pardon me, section 4 began on page 5, line 108. The section shall not apply to the following. And all this is a regulatory, I don't want to misstate the purpose of the bill either, a regulatory provision for registering a certain kind of financial product. And on page 6, line 130, paren F, is a language intended to exempt the product and client that you and I have discussed from this registration bill.
All right, thanks.
Are you good, representative of the group?
I'm not exactly sure.
Okay.
But I'm
Well,
just going to be a no.
They're carving out that group.
So you're
Yeah. Yeah, I didn't mean to cause problems. I'm happy to try.
because they're in existence now.
Yes, sir.
Right, because my collateral source bill did not pass, and all you're doing is carving them out of this.
Yes, sir. So yeah,
trying to do?
I'm going to say this is a registry bill, not a licensing or, so all we're saying is that our companies would not be included in this registry because the product that we sell isn't matching that registry. If we were to transition a business format to where it was a specific rate, that fits within this rate, then obviously we would become registered.
All right, that makes more sense. Thank you.
Thank you, sir.
Representative Clements?
Yeah, thank you for trying to help explain this. I just want to be abundantly clear. Were we in danger of drawing the industry in the previous language, and can you explain to me how?
Yes, so there's kind of two models for this legislation across the country. My folks have been just trying to make clear, because some of those versions work from a APR disclosure perspective to say there's, you have to disclose your APR, right? Our product doesn't really have an APR because I'm not going to know the outcome of that lawsuit or the settlement amount, or even if there's going to be availability to recoup my costs. So within the format of this version of the bill, which is, I think, not specifically an APR registry, the description of what a commercial lender provider was just vague enough that we felt we wanted just to have that certainty to add this exemption. I know I may misstate which state. I believe it's New Jersey. Similar bill. We've worked with their national association that's been working on this legislation to try and make that modification just in every state. And I think it's just simply a matter of saying, hey, just in case, because our product doesn't have the same kind of a definition, and it's not the same purchaser or seller of those products, we just wanted to be clear that it doesn't then put us in the point of registering.
Well,
Not that we aren't registered businesses, right, but just for this purpose.
So that's the driving force behind this legislation to begin with, is that this is a loan vehicle that is different than a traditional, what we think of mortgaging your house or something like that, right?
That's my understanding.
A business loan has different variables, and APR is actually not one of those things that we look at in this.
Right.
And so my question is, this is a disclosure bill, basically. What it does is it allows a lender to see up front what's happening, that the terms are all standard for everybody. You know, I can compare this loan to this loan, and I'm good to go.
Sure.
And I guess my curiosity there is, would those disclosures be a problem for your industry, or just not a fit to the degree that you feel you shouldn't participate? That's I guess what I'm asking.
Absolutely, yeah. So I think both. One, I think our product just doesn't fit within the mechanism that you're defining. And it's a hard product to define, right? I mean, it's a new form of finance that doesn't live in a bank. It kind of lives in this different space. And so as you're trying to figure out, well, who are those folks we want registering, our product is a product that I enter into a contract with a healthcare provider, right? So I'm not necessarily a financial lending institution. I obviously have to demonstrate that I have the credibility that you would ever, take my money, and that I would have the hope to recouping it. But I think that definitionally we're not a lender of a commercial product, because I'm working with a provider, an individual business. And I think the part of it is, so the sale, pardon me, if I understand correctly, the product that I don't sell, and I didn't know about until a few weeks ago, if I understand correctly, their model of reimbursement is based on the revenue generated by the business they're loaning to, right? I'm going to give you $100. If you make 1,000, I get whatever that number is, right? In our conversation around the collateral source rule, quite frankly, is that our product is that contract with an individual provider. It's not a commercial lent device, and so we feel like what our contract is and where it is regulated is through that lawsuit outcome.
And again, that is a special niche.
Yes, sir.
Special niche.
Yes.
And the reason I'm asking these questions, I just want to be sure that we're doing the right thing here. We got a great committee in terms of being able to put something on the floor that generally works for everybody. And I don't want to leave something I don't understand. I think I got you finally. And I see that Representative DeGroot has a follow-up. So I'm finished, Mr. Chair. Thank you.
I'm going to turn to Representative O'Donnell first.
Thank you, Mr. Chairman. To inquire.
Proceed.
So I'm curious, do you feel that your amendment, is that going to eliminate all factor products, or just more specifically to this healthcare related?
So I'm relying
Lawsuit
on, I'm relying on my client's legal counsel to assure that, because I kind of asked that question as well. Like, I want to make sure we're same way, right? I want to make sure I'm only getting us.
Right.
And it is my belief that's what this language does.
Okay.
In whichever the other state we've kind of worked on this, there's been a couple now. We think, it's very, very similar. As you know, every state kind of writes laws different. So there is a potential that the language isn't perfect, but that is our understanding after reviewing. And clearly our intent. We're not looking to, we're very clearly not looking up some other different door or escape hatch or anything.
Right. No, and I get what's happening here. So we've got an organization that's come to us and said, we don't fit the consumer model. APR doesn't work for us.
Right.
Well, now you're an organization that's coming to us and saying the model that's been brought to us to get all them, some different type of disclosure, that doesn't quite fit for us. So I'm good with that. To me, that's you're here for the same reason the bill was originally brought, is because they don't fit into that model.
Yes, sir.
You guys don't fit into this model. So I'm empathetic to your situation, and I'm comfortable with it.
Thank you.
Representative DeGroot.
Thank you. It's DeGroat, vote DeGroat, I'll remind everybody. We did have a very animated discussion, And I recall more of it now. His client, who I don't like very much, lives in between what the medical treatment is actually worth and what the hospital bills. And they bill at a higher rate because way too often it's let's make a deal. And his client plays on that margin in between. And so he wanted to gut my collateral source bill, which said you could only put in the low number at trial, and which would have made his client go out of business in the state of Missouri. And he couldn't come up with another reason to disagree with my bill or gut
Representative
my bill.
DeGroot, do you have a question for the
I don't.
witness?
I'm explaining the
Okay.
amendment. And the bottom line is, I'll tell you, I'm in favor of this amendment. While I do not like his client, I do think that it's comparing apples to oranges, and it just doesn't apply to them. As much as I want to be as mean to his client as possible, I can't figure out a reason in this case. Thank you.
All right. Thank you, I think. Okay.
I'm happy to come back and get
Sure.
yelled at for other
Any other
reasons as
questions in
well.
regards to the change to the substitute? Any other questions in regards to that change? All right. Thank you, Mr. Penman.
Thank you for the opportunity.
Okay.
Mr.
There was one other change to the substitute. Mr. Eaton, if you'll come forward, please.
I have I don't know if it's everything, so I'm going to flag, it's page 4 on mine, section G. G.
House.
Yep.
Substitute. Then we're going to
What does that mean? That's helpful.
So this is broker disclosure.
I'm sorry. I need to ask you to please state your name for those that
Sorry,
are
Alex
listening at
Eaton.
home.
Alex Eaton, registered lobbyist for the Revenue-Based Finance Coalition. We testified in support of the bill last week. We are the group that brought the bill forward. We have worked with Mr. Penman on his amendment. We are good with that. I think Mr. O'Donnell stated that correctly and kind of the intent there. So the second change is another lending group that on the broker disclosure language as originally drafted was a little too broad, that might possibly bring in disclosures for advertising. And so we're narrowing that down to just include broker disclosure on payments made toward brokers. That group is Inova, and working with them, we are good with that amendment also. So just wanted to flag that.
Questions for Mr. Eaton on that change for our substitute? Representative O'Donnell.
Alex, where is that change? Did you ever find it? Thank you.
Any further questions? Okay, so that was, thank you, Mr. Eaton. That was the changes for our substitute. Okay. So now we have an amendment, and the amendment is simply to 01H, and the amendment, we had the phrase "and the amount of compensation" got removed by accident during drafting and didn't get caught until after it was distributed. So this amendment is simply adding back in that phrase "and the amount of compensation." So with that, I have an amendment. We've spent a...
You're suggesting a change.
Okay, the order I had it was to accept the amendment and then accept the House Committee sub. Is that?
No, sub's already on the floor.
Okay.
Sub's already on the floor, but
Right.
right off the bat.
Right.
Okay, then you talk.
Right.
And then we adopt.
The amendment?
More discussion, and then you adopt the amendment.
The amendment.
And then you
Okay.
roll it into a new house.
Okay. Well, I thought we had it right because we spent a few hours trying to get that. So we are going to vote on the amendment, and then we're going to come back and we're going to vote on the sub. So is there any further discussion in regards to the amendment?
Voice vote to adopt.
Okay. So this will be a voice vote. All those in favor of adopting House Committee Amendment Number 1 signify by saying aye. Aye. All those opposed say no. The ayes have it. You've adopted the amendment. Another voice vote. I move we roll the amendment into the new substitute and adopt the substitute. All those in favor signify by saying aye. Aye. All opposed say no. The ayes have it. You've adopted the substitute. And now I move that House Committee substitute for House Bill 2706 be voted do pass. Again, is there any discussion? Seeing none, Madam Secretary, please call the roll.
Chairman Francis.
Aye.
Vice Chair O'Donnell.
Aye.
Representatives Clemens.
Aye.
Adams. Billington.
Aye.
Butts.
Aye.
DeGroat.
Aye.
McGurl.
Aye.
Owen.
Aye.
Railsback. Sander. Sauls. Shaw. Thompson. Trent. You have 13.
By your vote of 13 ayes and 0 noes, you have voted House Committee substitute for House Bill 2706 do pass. Thank you very much for your time. The committee is now adjourned.